My name is Megan Roberts, and I'm an agricultural economist here at Compeer Financial. I'm so glad you're with us today for our annual update on cropland prices and where things are headed in that market. Welcome to Compeer's Ag Edge, brought to you by Compeer Financial. In each episode, we break down complex agricultural economics, policy dynamics, and farm business topics into conversations that make sense for your operation. We're here to help you stay informed and confident about the trends and decisions affecting your agricultural business. And we're going to start today's with a bit of an update on where things are with, unsurprisingly, crop prices, since that does have some relationship, but not a full relationship with cropland prices. Let's talk weather, energy, and trade, because that really has been driving some of our crop economic conditions as well as interest rates over the summertime this year. So when it comes to corn prices, we did just last week have a brand new August WASDE. The August WASDE World Agricultural Supply and Demand estimates can be a market mover, and it did move our futures markets, but we didn't see a lot of change in what the USDA is predicting for farm level prices. In the last month of the August WASDE, there was a 10-cent increase. This was driven by a combination of factors, a little bit of a reduction in projected yield for 2026 because of some challenging weather conditions. But then also there was some projection for really good demand on both the domestic demand side, but also in particular for corn exports. And so that's what drove that 10-cent increase in the farm level price. But overall, the story I want to tell about corn price trends in the WASDE and how that relates to something like farmland prices is that we really haven't seen a lot of movement in the last year and a half, and it has been a really challenged market. We're seeing a little bit of price improvement right now. We also saw that back in May, but it is, for the most part, a market that has some really compressed margins. A little bit of a similar story on soybeans. USDA does have a $1 differential on the prices between last year and this year. So there is some price improvement, a little bit more of a price improvement for soybeans, because we are seeing some increased demand right now today as compared to a year ago when we were not seeing export sales to China at this point 1 year ago. Today, we're also seeing good domestic demand for soybeans, and that has driven just a little bit of a price increase of the WASDE price from old crop to new crop. That said, on a month-to-month basis, there was not a change in the last August WASDE. Last week, they very subtly reduced the yield projection by just a third of a bushel projection per acre, and they left the farm gate price the same at $11.40 per bushel for soybeans as their estimate for this upcoming season. So the question really becomes, what is going to happen with geopolitics, and will that change some of the USDA estimates that we're seeing right now? And that is not only related to things like fertilizer and energy coming out of the Red Sea and the Strait of Hormuz, but we're also seeing, unfortunately, increased conflict in the Black Sea region. And that can have a bigger impact on grain prices because the Black Sea region, meaning the port of Odessa and other major ports that Ukraine and Russia access, they have a lot more grain exports that come out of that region. And so that can create a more dynamic grain pricing situation, similar to what happened in, for instance, 2022. We're not seeing that yet in 2026, but certainly there's a lot of geopolitics at play, and that is having an impact on corn and soybean prices, but then also the margins due to rising input costs. When margins are squeezed, the farm safety net often gains greater attention. We don't have a new farm bill, but we do have from a year ago an increase in the Title I Farm Safety Net. So that's a portion of the Farm Bill that was able to be included in the One Big Beautiful Bill Act of July 4th of a whole year ago, 2025. But those payments had a delay until October of 2026. Those would be payments that are a function of commodity prices. And that is from that July 4th, 2025 legislative act that will finally be paid out now in October of 2026, the ARC and PLC programs, for instance. And so we're seeing a stronger direct government payment to farm producers from that portion of the Farm Bill, but also payments that are not a function of commodity prices, that are ad hoc or one-time payments. So a really large portion of some of the direct government payments in the last 2 years have been from ad hoc payments. And that has helped create a stabilization of overall USD net farm income forecasts. So we have these lower corn and soybean prices. Sometimes I get asked, why are land prices not cheaper if corn and soybean prices are cheaper? Well, overall net farm income has not dramatically declined in the last 2 years. In fact, it is flat for the last 2 years. Also, there is some thought that this forecast for 2026 overall USD net farm income will increase with their next round of data updates, which will happen in a few weeks here. So it may even be an increase over 2025. And that leads to, I would argue, some stability in things like farmland prices, even though we are facing some compressed markets. Let's move over to interest. So the other thing that can compress margins, it's not our only cost, but I do work for a financial institution. So interest rate costs are important. And we have seen the interest rate forecast change in 2026. There was some thought at the beginning of the year, including my thoughts. So I was on the record saying this at the beginning of the year, that it was likely we would see perhaps 2 cuts, which would be 50 basis points or 0.5% lowering of the Fed funds target rate. And we anticipated that market interest rates would follow suit. And they did preemptively in early 2026. Since March, however, those market interest rates and also the forecast for the Fed funds rate have been pulled back. And now it looks like instead of 2 cuts, we will either be in a continual pause, or there are some forecasts that show as much as 3 hikes yet this year. That's probably on the lower probability side, but I did want to put in just that range to show the variation of where analysts are thinking the interest rate forecast could go. This is really driven by those energy shocks and some of the challenges in the Red Sea, Strait of Hormuz, that have rippled across into higher inflation. The new Fed chair appears to be hawkish on inflation, and that also is weighing in to some of these forecasts. So to wrap this section up, and hopefully I've done a good job of laying a nice economic foundation for Jade to get into the real nuts and bolts of today's content. Even though crop margins are tight and interest rates are in a higher for longer, though still moderate range, the cropland market is generally remaining pretty stable due to some fundamentally different supply and demand economics than commodities. Commodities are a different supply and demand curve. And with farmland, we have a much more limited supply. And I think you're going to hear some of those same things from Jade as we move into her content. And I'm going to hand it off to you, Jade.
All right. Awesome. Thank you so much, Megan. My name is Jade Kruschke. I am one of the Appraisal Regional Managers here at Compeer Financial. I am located in Northwest Wisconsin, so right on the border here between Wisconsin and Minnesota. And on my team, I've got the Baldwin appraisal team as well as the Minnesota appraisal team. So that's kind of my focus. My husband and I farm here. So this has just been a great place for me to be and something that truly is a passion of mine. I love digging into the land values and stuff. So we'll jump right in. I know all of our lives are pretty hectic right now as we're getting started on state fairs, wrapping up county fairs, family vacations, all the things. But we're going to take some time to pause and dive into land values. Land is still one of the biggest long-term decisions that many of our customers make, many of our customers like you. And whether someone's looking to buy or sell or refinance or even rent or understand what they own, A lot of these same questions keep coming up. What is the market really doing? So like Megan mentioned, my answer is very similar. So I said the short answer is the market's holding together very well. It's not moving the same way everywhere, though. We've got strong support for quality land. We've got a very selective market on our hands. They're wanting more local, more dependent on individual property types. They're just taking these decisions very seriously because of the price associated with them. So with that, I will start with some key takeaways that I hope you can leave today with. We're going to dig into our Compeer benchmarks. We've got 50 plus benchmarks that we do on a monthly and a yearly basis. So I want to give you some insights into what we found here at our full benchmark update in July. And then I want to break it down by state. But at the same time, I really am keeping this a regional perspective just because it gets really nitty gritty when you start diving into the individual markets in our area. We will talk some about recreational sales across our territory, and then how is land selling? When I say how is land selling, is it on the open market? Is it privately? Is it auctions? That kind of thing. So I'll give you a little insight into what we are seeing here at Compeer with these sales that we have analyzed and put into our database that we use to value our properties, and give you a little insight into what we see there. And then I'll go into market activity across our territory from the past year, as well as some cash rental rates on cropland. I thought that might be intriguing. Typically, if you're interested in land values, you're probably wondering what the rental rates are too. So let's get started here. Our appraisal department, we have been appraising roughly 50 benchmarks over 5 states, and we've been doing this since July of 2021. We do this on a monthly basis. We pick a property and we appraise it every single month. And then once a year, we do a full narrative appraisal just to get down into the nitty gritty. And then that's also what we provide to AgriBank. So as our benchmark data. Because the benchmarks are spread out throughout our territory, like I said, I just want to keep it regional, not getting down into the individual counties or local markets. But like I said, the broad conclusion is that farmland values remain durable, but they're not all uniform. All 3 of our states, being Minnesota, Illinois, and Wisconsin, are portions of those states, showed positive benchmark changes this year. Overall, Illinois was up 2%, Minnesota was up 3.8%, and Wisconsin was up 8.5%. The simple average across the 3 states was approximately 4.8% this year, and I was reporting 3.7% last year. So up just almost another percentage point. I've got cropland only benchmarks. So what I did there is I took out our recreational benchmarks because our rec land really is showing lots of increases. So I took those out, and then I gave you our cropland only benchmark appreciation scales. So in Wisconsin, we're showing 8.7%, 1.4% Minnesota, and then just 0.1% in Illinois. The increase from last year, I was reporting 3.7 to 4.8 this year. It does prove that the market's accelerating, but it's showing a longer trend that appreciation has moderated significantly. 2021, 2022, 2023, our bars are way up there. And now 24 and 25, we've kind of settled out into this moderation period. So lots goes into the why on why we've settled out, but we'll get into that as we move in. So we're going to jump into a state by state update here. In Minnesota, our territory, we have it split into 2 benchmark regions. We've got 5 benchmarks in the central region, and then we have 10 in our southern region. So combined, all of these increased 3.8% over the past year. And last year, I was reporting a 1.4% year over year increase. So these Minnesota benchmarks are up about 2% year over year. We did see values still climbing. Overall, out of the benchmarks we have in Minnesota, we had 2 of them decline in value. A lot of that attributed to just the quality of the sales we had in that area, with high quality land still holding strong, and some of the more average or lower quality parcels maybe not even selling or selling lower in that particular area. We had 2 benchmarks that did not change at all. So they had 0% change across the past year. And then 11 of those did climb about 1% to 22%. And then 3 of those benchmarks are actually recreational benchmarks. And those are the ones that are getting it up to that 22% range. So between the 3 benchmarks we had on the rec side, those were 8 to 22% increases. So I thought this was intriguing to point out, just to kind of give you the overall range there. Of the 15 Minnesota benchmarks that we track, 9 of them are valued at $10,000 an acre or more, with 4 of those exceeding $12,000 an acre. So I think that helps to paint the picture of what's going on in Minnesota and kind of give you a gist of, on average, where a lot of those values are hitting. Up there in that central Minnesota, northern Minnesota range, recreationals in that 4,400 to 4,700, cropland in that 9 to 11, and then southern Minnesota, our benchmarks at 6,000 for rec, and then 8 to 13 for cropland. So lots going on in Minnesota. Let's scoot over here to Wisconsin. And I would say we have more going on in Wisconsin. This is a little bit bigger of a story here. Land values here are less influenced by cash grain prices than what we see in Illinois and Minnesota, but they're more in line with milk prices or what's going on the dairy farm. So not even just milk prices, but what's going on the dairy farm, the demand from the local dairy market. In Wisconsin, we track 1 dairy benchmark separately. So this is an improved farm that we analyze monthly and yearly. And then we do 14 bare land benchmarks, with 4 of those being recreational. Our dairy benchmark this year did show an increase in value. So if we've got some dairy listeners on here, that's a positive for those of you. We've got a 6.3% increase in value on our improved dairy benchmark. And you guys know what's going on out there. You're not oblivious to this, but it's driven a lot to high construction costs and the strong land prices around the dairies. So that's a lot of what we saw in that dairy benchmark. The bare land benchmarks, we had strong increases here compared to our other 2 states. So we had an average of 8.5%, though this is slightly down from last year. Last year at this time, we had 9.7% is what I was reporting to you last year. When I break those benchmarks down just a little bit more, I've got 1 benchmark that saw a 4% decline. We had 3 that were very steady. So 0 to just like 0.4% increase. And then we had 10 that showed pretty decent increases in value. So this is a wide range, but they were 1.5 to 35.6%. I'll get to that here in just a second. But there were 3 of those 10 benchmarks that showed that increase in value showed increases from 24.2% to 35.6%. You're probably wondering what in the world is going on in this area. And I'm gonna take it back to 2 of the 3 are dairies. So the 3 counties that we saw these big jumps in were Calumet County, St. Croix, and in the Dodge County area. All of them driven by different reasons. Calumet was more specific to dairy expansion, gathering land next to operations. And then St. Croix benchmarks, we just hadn't had a lot of data and sales that had occurred recently around our St. Croix benchmark there. And within the past 10 to 12 months, we had 3 sales that were within a 10-mile radius that were all around $10,000 an acre plus or minus. So that benchmark we had sitting at 8,000, we had to jump it quite a bit. And so that's what played into the St. Croix County benchmark. The Dodge County, those of you in that area of Wisconsin, you know what's kind of going on there. But Dodge County, the land value increase, a lot of it is due to commercial and dairy waste producers needing land to spread on. So there's some commercial waste and dairy waste that is creating a lot of demand for land in that Dodge County area. And then on top of that, the Dane County dairies moving into Western Dodge County as values are just slightly less in that area. So Dane County holds the highest bare land value benchmark that we have, sitting at $20,000 an acre. And then Dodge is right behind it at $14,912 is what we have that benchmark at right now. So a lot going on in Wisconsin, kind of driven by dairy in a lot of those areas. As we move into Illinois, values, we break these out by class A, B, and C farm types. So this gets down into productivity index, how productive are the farms, and that kind of thing. So that's why we break those out in A, B, and C farm types. It's increased a smaller margin overall. So in Illinois, we had 2% overall, which is up from what I reported last year, where we actually had a decrease across the territory, though it was less than 1%. It wasn't much of a decrease, but we're speaking of the numbers as they came to us, it was just less than 1%. In Illinois, we have 21 benchmarks here. 3 of those remained unchanged. 11 increased between about 2% and 17%. And then we did have 7 that declined in Illinois by about 1% to 14% throughout the year. We have high quality Class A cropland declining roughly 1% year over year. The good quality Class B farmland saw a 1% growth. And then the average quality Class C farmland did post an increase of 4.3%. So what this shows me is that we have a softening in Illinois. I don't say this across the territory. I think this is specific there because I would say I was just telling you the opposite about Minnesota. The trend shows softening in the high quality land segment. And then while average ground remains stable. So in northern and western Illinois, recreational benchmarks rose by 9.3% up over the 7.2% that we discussed last year. So the Illinois recreational benchmarks are in that 7,700 to 8,200, where last year we were talking about 7 to 7,500 on the recreational benchmarks. All right, so private sales are the largest source of recorded cropland transactions in all 3 states. So this is how we here at Compeer are seeing a majority of the land sales take place. That Wisconsin's the most private sale driven state, while Minnesota and Illinois have a more balanced mix of private, advertised, and auction transactions. So this matters because public auction results are often more visible in the market. Those are the ones we go around talking about. They are important, but I also want everyone to understand that this isn't the entire market. So there's a highly competitive auction can establish a strong data point, while many of these privately negotiated sales that occur with less visibility that a lot of people don't see or hear about are still very relevant in the market as well. You may be sitting there saying, well, like, what does this mean for me? I'm a lender, or I'm a realtor, or I'm a landowner. So I broke it out a little bit. And what does that mean for you? So for a landowner, what sales strategy should I have if I'm looking to sell my property that gives it the best access to its likely buyers and that I'm going to get the highest and best price for my property? So what we're seeing is highly desirable farms with broad appeal are benefiting from that wider exposure. A parcel with maybe a smaller buyer pool, a more unique property or operating fit or sensitive ownership situation, that one may be suited better for a private or more targeted marketing process rather than hitting the auction market. For the farmers and other buyers, it might explain why a market can feel competitive even when we're not seeing a lot of public auctions. A private sale market, buyers may need to maintain relationships. You think about the dairies and that land around them being in high demand. There's a lot of relationship maintaining that needs to go on there so that when it becomes available, they can act quickly and they've got those relationships established because there might be fewer chances to bid publicly. But it does not mean that demand is weak. For us lenders, for those lenders out there and investors, it's a reminder that comparable sale research needs to go beyond just those advertised listings and auction results. It's real easy for us to chit chat with our clients about, well, this auction sold for 10 or 15,000 an acre, but there might be 2 or 3 other sales in that same immediate area that we also should be talking about that maybe we're higher or maybe we're lower, just to be able to make sure we're telling the whole story to our clients and giving a good representation of the market value. For us appraisers and advisors and consultants out there, it's why we don't rely on the highest sale or the most visible sale for reasons I just said. We take a full look at the set of data available in the market, and then we consider whether the property had adequate exposure whether the buyer pool was your typical buyers or whether the terms were market oriented. So I would say the key takeaway, sale method, it doesn't automatically determine the value. Instead, it gives us important context around the value indications. We need to understand both the price and the process behind the sale. So this is one of my favorite parts about appraisal. And I would give this to those listening is if you do get a call from a local appraiser or whatnot, confirming a price on a transaction you recently bought, a lot of this goes into the data I'm providing you today. We try to do a really good job at verifying and analyzing all of our data so that we can provide these updates to you about what's going on. So just work with them, let them know if you're comfortable, all the thought process you put into establishing that purchase price, because that really helps us analyze that data. All right, let's get into some cash rents on cropland. So I want to shift over here because the rent gives us another view of the economics behind the land market. There's 297 reported Wisconsin sales from that time period of July of 2025 through the last day of June in 2026. So this is a statewide reference point, not a prescribed rent for one and any individual farm. This is across the state, sales we have analyzed in our database, cropland only. So all the recreational sales are taken out of here. Most of the reported rents are between 150 and 300 an acre. The largest single group is in the 150 to 199 range, which is also reflected in that most common rent of $150 an acre. The average rent we are reporting in Wisconsin is in that 224 range. And then the median that we see is 210 per acre. So that 150 to 300 is kind of all encompassing. The average being modestly higher than the median tells us that the higher rent farms are lifting the state averages. We've got observations above 300, but a smaller number. So much smaller range up above there. I would say the key takeaway from this, it gives us a useful starting point, but there's a lot that goes into this. Productivity of the fields, drainage, operational utility. How is the field configured? Just the local demand. You think of the land around the dairies, like they need it to grow their feed, or maybe something in northern Wisconsin that doesn't have as much demand or isn't in a more recreational area. But I do think it tells a real good story of what our rents here in Wisconsin are sitting at. So as we move from Wisconsin to Minnesota, the first thing to notice is that Minnesota rent market sits at a higher level. It's more concentrated in the middle of that distribution there. In Wisconsin, the observations were spread more broadly. And now in Minnesota, our large concentration falls between that $250 and that $325 per acre range. The median's higher. We're at $275 an acre. That's telling us that the lower rent observations are pulling the average down. For a typical observation in the sample, the middle or the most common rent level may be more useful reference points than just the average alone here. The most common rent at $325 per acre. This is the most frequently reported rent that we've got. Also doesn't mean that every property is going to rent at $325. So a lot of that is your southern Minnesota territory. That's where that strongest concentration of rents is. So this is useful for landowners. It's given us a realistic market range. For operators, it's helping frame where the market's clustering and where a proposed cash rent sits relative to the broader sample. So anyway, I think this brings a good perspective. I didn't report on this last year here, but it does sit pretty similar. I would say we haven't seen a big jump in cash rents over the past year. All right, so as we wrap her up here with Illinois on the cash rent side, this is even higher. So Illinois is our highest rent level of the three states. We have an average rent of $344 per acre with a median at $345. All of these numbers very identical when you think of the data set we have here. The close relationship tells us that the distribution is fairly balanced. So that's what we're getting here. We've got most of these observations are between 250 and 400. With 300 being the most common reported. It's supporting the idea that Illinois has a higher rent market overall, which they're also showing the highest land values too, most steady on the high side. So As we move from Wisconsin to Minnesota to Illinois, the statewide rent reference points rise, like I said, but the important message is not that every Illinois acre should rent at the statewide average. Like I said about the other two states as well, it's also tied to productivity, drainage, and all the things. What causes demand for cropland cash rents? All right, a little bit about the recreational land market. So I broke these down into the 3 states, and rec land, as you guys are aware, has a distinct different market than cropland does. Market participants that are interested in purchasing these type of properties, there's about 600 sales that I've included here. Illinois has the highest median price per acre at that 7,700, which is right there in line with our benchmark value. And then Wisconsin sitting at 6,200 and Minnesota at 4,466. All these numbers falling within that range that I reported on the recreational benchmarks. So I think an important thing to keep in mind when looking at this data is Wisconsin is providing the largest sale sample. So about 324 of these transactions that I've included out of 600 are sitting in Wisconsin. Some things that are impacting them: parcel size. It's not the whole story, but the size of the parcel is very important. The median sale is 77 acres in Illinois, 67 acres in Minnesota, and 52 acres in Wisconsin. Rec properties are buying for all different reasons, but a lot of them being hunting water, timber, views, cabin potential, access, and those kind of things. So within each state, local markets vary substantially. In Wisconsin, you've got the northern counties such as Vilas, Oneida, Sawyer, the counties up north that are completely different than your driftless counties. Grant, Crawford, Richland, Vernon, Buffalo County, different drivers of value, different ranges of values. But this is also very true in Minnesota. You've got the North Central Lakes, Cass, Hubbard, Itasca, Aiken, counties like that. They've got different buyers than you do down in Wabasha and Fillmore and Houston and those kind of areas. Same goes for Illinois as well. The number of recorded cropland, and I've included improved farm sales, the number of recorded sales has softened over the last couple of years. So we've seen each year just a few less sales occurring and transacting that we find are applicable and that we put in our appraisal database. So from August 24 through July of 25, Illinois had 918 recorded sales. Minnesota was at 549 and Wisconsin at 464. And then in the most recent, from 25 to 26 period, those counts are down to 705, 438, and 319. It's a meaningful decline in recorded activity across all 3 of the states. It's roughly about 24%. I would be just slightly cautious. I'm a little bit careful with that most recent data point, just because sales do take some time to close. If you've ever bought or sold, you know how long that transaction process can get, especially if you need a survey or anything. So it takes us a little bit of time to get caught up with July, that June, July time, getting those sales analyzed and into our database. But I mean, I think you can look over the past few years and still see a little bit of that same momentum, just fewer transactions available to observe, which means the market can feel tighter or that the comparable sale pool can just be thinner. The important question: are fewer sales signaling weaker land values or simply fewer opportunities of trading? So this is where I've taken the total sale price volume, and it's just giving us another piece of the story. So when we compare August of 2023 through July of 2024, when we compare that through 2025, the total sale price volume has remained remarkably steady, all very similar state by state throughout that time period. So what does this tell me? A lender might question this and say, well, how is loan volume up if we're reporting less transactions each year that are selling? I think my whole presentation explains the why behind that. We've talked about values holding steady in some areas, having decent growth trajectory in other areas. So we can have fewer sales if each of those sales are selling for more than they would have a year ago. I think this tells a great story, as Illinois was essentially flat going from this 2024 timeframe to 2025 timeframe. It's sitting at about 1.2 billion in total sale price. Minnesota also very close. We have a very small small change there. We went from about 558 million to 547 million. Wisconsin increased roughly 378 million to 503, a little bit of a gain there. But I think that also goes into, we saw the highest land value increases in Wisconsin. So that makes sense to me. So anyway, I think this tells a really good story between total sales that we see selling per year versus total sale price volume on these in particular transactions. So with that, I will wrap up here. I just wanted to give you some tools and resources that our appraisal team has that we can use to support you. So if you have any questions about any of the information provided today, or would just like to dig deeper into our benchmark data, we have lots of it. And so we're more than happy to share. If you go to our website, our Compeer.com site, and find your way to the appraisal tab, we have a land locator, and then we have a Find My Appraisal tool. I even use the Find My Appraisal tool daily. Sometimes I'm like, I forget who covers that county. So I go to it very often. So if you're looking for anybody to just call up and ask some questions to, that's where you can find your experts in the appraisal world. We do lots of podcasts throughout the year, and we have a newsletter. So with that, I'll say thank you. Thanks for joining us today.
With that, just a huge thank you to Jade, and then to all of you for joining us. Thank you for listening to Compeer's Ag Edge. You can follow us on Apple Podcasts, Spotify, or your favorite podcast app. For more agricultural finance insights and resources, visit Compeer.com. That's COMPEER.com. Until next time.